The silver market, long ignored and mocked, suddenly exploded into the global spotlight. Screens across trading floors lit up with numbers that made even veteran investors pause. In Shanghai, silver was reportedly touching $95, not $29, not $35, but 90-5. At the same time, a darker headline began spreading quietly, then all at once. A criminal probe connected to the Federal Reserve. At first, it sounded like noise, another rumor, another internet theory. But this time, the reaction was different. The markets felt it. Silver did not move slowly. It surged. For decades, silver had been treated as the poor cousin of gold. It was manipulated, capped, and suppressed by paper contracts traded in volumes far beyond the physical supply. Traders joked that silver never moved unless someone wanted it to. But now, it was moving without permission. In Asia, demand for physical silver had been rising quietly for years. Industrial users, solar manufacturers, battery producers, and private investors were steadily draining supply. Western markets ignored it. Paper contracts kept prices calm. Too calm. Until they didn't. When Shanghai prices began disconnecting from Western exchanges, something broke. The gap was no longer small enough to ignore. It was a message. Physical silver was no longer playing by paper rules. At the same time, whispers turned into headlines. Investigators were reportedly examining long-standing practices tied to interest rates, liquidity tools, and market operations connected to the Federal Reserve System. The word criminal entered the conversation, and confidence cracked. Markets hate uncertainty. Metals love it. Silver feeds on distrust. Every time faith in institutions weakens, silver remembers what it was built for, not promises, not debt. Reality, retail investors noticed first, then hedge funds, then industrial buyers. Suddenly, delivery times stretched. Premiums rose. Dealers stopped guaranteeing availability. What had once been abundant was now limited stock. People began asking dangerous questions. How much silver actually exists? How many paper claims are written against each real ounce? What happens if everyone asks for delivery? In Shanghai, buyers were not asking questions. They were buying metal. The reported $95 price did not mean every ounce sold at that level. It meant something more important. It meant true price discovery was beginning in a market that demanded physical settlement. No paper tricks, no rollovers, no excuses. In the West, prices lagged. But the pressure was building. Every suppressed market eventually snaps. Silver had been compressed for decades. The spring was tight, too tight. Meanwhile, mainstream media stayed cautious. Headlines softened the story. Words like volatility and temporary imbalance were used. But traders knew better. You do not see this kind of divergence without a structural failure underneath. The Federal Reserve probe added fuel to a fire already burning. Even the hint of wrongdoing was enough to make global investors rethink risk. Trust is fragile. Once cracked, it shatters quickly. Gold moved too, but silver stole the show. Because silver is smaller, thinner, more explosive, a small market does not need much force to move violently. Industrial demand was no longer optional. Green energy policies, electric vehicles, and solar infrastructure required silver in quantities that could not be substituted easily. There was no backup metal waiting in the wings. At the same time, mines were struggling. Costs were rising, new supply was slow. Environmental regulations tightened production. Years of underinvestment came back to haunt the market. Silver was cornered from both sides. Demand surged. Supply stalled, and above it all hovered one uncomfortable truth. Paper silver was a promise. Physical silver was power. As news of the Shanghai price spread, Western investors began waking up. Forums exploded, charts were shared. Old warnings resurfaced. Analysts who had been ignored for years suddenly sounded less crazy. This was not just about price. It was about control. If silver broke free, it would expose how much of the global financial system relied on confidence rather than substance. That made it dangerous. And danger attracts attention. By the end of the day, one thing was clear. Something had changed. The silver market was no longer sleeping. It was watching, and it was ready to move. The first official statements were calm. Too calm. When questions surfaced about a criminal probe tied to the Federal Reserve, spokespeople used familiar language. There was no immediate threat. There was no systemic risk. Markets were told to remain confident. But behind the scenes, something was shifting. Silver continued to rise. Investigations do not appear suddenly. They begin quietly, with documents, emails, and internal reviews. What made this different was timing. The probe emerged just as global. Trust in financial institutions was already weakening. Inflation had eaten savings. Interest rates had punished borrowers. Banks were exposed. People were tired of being told everything was fine. Silver felt that exhaustion. As regulators reviewed years of data, traders began reviewing history. They remembered past scandals, interest rate manipulation, currency rigging, commodity spoofing. Each time fines were paid, no one important went to jail. Confidence survived, but it never fully healed. This time, the scale felt larger. The Federal Reserve was not just another institution. It was the backbone of global finance. If its credibility cracked, everything connected to it would feel the shock: bonds, currencies, derivatives, and especially metals, silver. Traders understood something simple. If trust in paper systems weakens, physical assets gain value. Not because of fear alone, but because of math. Paper can be created endlessly. Metal cannot. In Asia, the response was direct. Buyers demanded delivery. Contracts that once rolled forward were now settled physically. Warehouses reported tighter inventories. Export restrictions quietly increased. No announcements were made. But supply slowed. Western exchanges felt the pressure almost immediately. The price gap between Shanghai and Western markets refused to close. Arbitrage should have corrected it. That was how the system was designed. But arbitrage requires metal to move freely. And metal was no longer moving easily. Something was stuck. As the investigation expanded, rumors multiplied. Some said it focused on liquidity programs. Others pointed to interest rate signals. A few whispered about coordinated market interventions stretching back decades. No one had proof, but the uncertainty alone was enough. Markets do not wait for verdicts. They move. On suspicion. Silver became a hedge not just against inflation, but against exposure. Investors began asking a new question. What happens if paper claims are challenged? That question changed behavior. Large holders quietly reduced paper positions. Physical demand rose. Coins, bars, and industrial stockpiles disappeared faster than expected. Premiums detached from spot prices. The real cost of silver became harder to define. Meanwhile, mining companies struggled to respond. Bringing new supply online takes years. Exploration budgets had been cut during the long period of low prices. Shareholders had demanded discipline. Now discipline looked like a mistake. Silver did not care. As investigations continued, the Federal Reserve maintained its operations. Interest rates stayed firm. Liquidity tools remained in place, but perception had shifted. The aura of absolute control was fading. And silver thrives in the cracks. Financial commentators debated whether the Shanghai $95 figure was exaggerated. Some called it misleading. Others said it reflected local premiums and contract structures, but none could deny the trend. Prices were rising everywhere. The disconnect itself became the story. Why would one market price silver so much higher than another? The answer was uncomfortable. Because one market demanded reality and the other traded promises. This realization spread slowly. Then all at once, retail investors were late but loud. Videos trended, headlines multiplied. Old charts resurfaced, showing decades of suppression. Silver was suddenly no longer boring. Institutions noticed. Hedge funds repositioned. Some covered shorts. Others bet on volatility. Banks adjusted exposure quietly. No one wanted to be caught on the wrong side of a metal that was no longer obeying rules. The investigation cast a long shadow. Even if it ended quietly, the damage was done. Trust once questioned is never fully restored. Silver's role changed in the minds of investors. It was no longer just an industrial metal or a speculative trade, it was a signal, a warning. A mirror reflecting stress in the system. As weeks passed, pressure continued building. Inventories thinned. Delivery times stretched further. Contracts grew riskier. Each day without resolution added tension. The market was no longer asking if something would break. It was asking where. And silver was at the center of it. By the end of part 2, one truth had become clear. The investigation was not just about past actions. It was about future confidence. And confidence was bleeding out, ounce by ounce. Silver had not reached its peak. It was just getting started. The moment did not arrive with an explosion. It arrived with silence. For years, silver prices across the world had moved like shadows of one another. New York, London, Shanghai, different clocks, same direction. That was the illusion of unity. But now, the silence between markets grew louder than any headline. The prices stopped following. Shanghai did not wait for confirmation from the West. Contracts there were being settled with real metal, not paper extensions. Buyers were no longer interested in leverage or future promises. They wanted weight. They wanted delivery. That demand changed everything. In Western markets, paper silver still dominated. Contracts were rolled, positions netted, risks spread across layers of complexity. It worked as long as confidence held. But once Shanghai prices surged and stayed high, confidence began to fracture. Traders noticed that arbitrage, the mechanism meant to equalize prices, was failing. The metal was not flowing west to east or east to west. It was staying put. Warehouses were tighter than reported. Some inventories were spoken for long before they were officially counted. This was the breakaway. Physical silver had separated from paper silver. Western analysts struggled to explain it. They spoke of temporary distortions and logistical bottlenecks, but the truth was simpler. There was not enough metal to satisfy everyone at once. Silver had been oversold for decades. Every paper ounce represented multiple claims. That system depended on one thing: most people never asking for delivery. Shanghai had changed that rule. Once one major market demanded reality, the illusion everywhere else weakened. Meanwhile, industrial demand accelerated. Solar production expanded faster than expected. Governments pushed green policies harder. Electric vehicle manufacturers locked in supply contracts aggressively. Silver was no longer optional. It was essential. At the same time, investors who once dismissed silver as too volatile began reconsidering. Volatility was now the point. In a world where bonds lost value and currencies weakened, silver offered something different. It did not promise stability. It promised truth, and truth was expensive. Prices in Western markets began climbing faster, not matching Shanghai yet, but chasing it. Each upward move forced short sellers to adjust. Margin requirements increased. Risk models flashed warnings. Some funds exited quietly. Others were forced out. The squeeze did not happen in one dramatic moment. It happened in layers, one short covered, then another. Each exit pushed prices higher, pressuring the next. This was not panic. It was math. As prices rose, questions grew louder. How much silver could actually be delivered? How many contracts could be honored if demand surged further? Exchanges reassured participants. They always did, but reassurance is not supply. Meanwhile, news from the investigation continued leaking in fragments. Nothing definitive, no dramatic arrests, but enough to keep doubt alive. That doubt fed the breakaway. Investors did not need proof, they needed risk. Silver absorbed that risk. The metal began behaving differently. It no longer reacted to daily headlines. It moved with momentum of its own. Corrections were shallow. Rallies were aggressive. Volume shifted toward physical products. Coin shops reported shortages. Online dealers adjusted prices hourly. Premiums rose far above spot. The real price of silver became subjective. Depending on where and how you tried to buy it, this fragmentation mirrored the markets themselves. In Asia, silver was treated as strategic. In the West, it was still treated as a trade. That difference mattered. Strategic assets are held, trades are flipped. When pressure rises, traders sell. Strategic holders do not. Supply tightened further. Mining companies watched in disbelief. Their share prices rose, but production could not respond quickly. Years of low prices had hollowed out capacity. Permits were slow, capital costs were high. Even with rising prices, silver could not be conjured overnight. The breakaway was now. Visible dot charts that once moved together diverged sharply. Analysts began drawing uncomfortable comparisons to past market failures, not crashes, but dislocations. Moments when price signals stopped reflecting reality. Silver was no longer signaling comfort. It was signaling stress. Central banks watched closely. Officially, silver was not a reserve asset. Unofficially, it mattered. It sat at the crossroads of industry, finance, and trust. If it broke free completely, it would expose weaknesses no policy tool could easily fix, and the public noticed. Search trends surged. Videos spread. The phrase physical silver replaced silver if in discussions. People wanted what they could hold, what they could verify. The breakaway was not complete yet. But it was irreversible. Once markets stopped believing in alignment, they never fully return. Even if prices converge later, the memory remains. Trust does not reset. It decays. By the end of this phase, silver was no longer asking permission. It was moving on fundamentals long ignored: supply, demand, delivery. The investigation continued, the price climbed. The gap remained. Silver had escaped its cage, and what escapes rarely goes back quietly. The reckoning did not arrive with a single announcement or a dramatic market halt. It arrived through exhaustion. Exchanges were tired. Traders were strained. Institutions were forced to explain movements they no longer controlled. Silver had pushed the system to a point where every assumption had to be revisited. The investigation into the Federal Reserve reached a stage where silence became impossible. While official statements remained cautious, internal reviews, audits, and regulatory coordination intensified. The goal was no longer to reassure markets. It was to contain damage, but silver did not wait for containment. Prices continued to rise, not in wild spikes, but in relentless steps. Each pullback was met with buying. Each dip disappeared faster than the last. This was not speculation anymore. It was repositioning. Investors had made a decision. Silver was no longer treated as a side bet. It was treated as protection. Western exchanges attempted adjustments. Margin requirements were raised again. Position limits were discussed. New rules were proposed under the language of stability. But the market understood what stability really meant. It meant slowing something that was moving too fast. Yet rules cannot create metal. As settlement pressure increased, exchanges leaned harder on cash settlements. Contracts were closed with dollars instead of ounces. Officially, this was normal. Contract terms allowed it. But psychologically, it was devastating. Cash was not what buyers wanted. The more cash settlements appeared, the louder the message became. Physical silver was scarce. Scarcity does not negotiate. Shanghai continued operating under different logic. Delivery mattered. Reputation mattered. A market that fails to deliver loses credibility instantly. That discipline kept prices elevated. Buyers accepted it because they received metal. The gap between markets no longer shocked anyone. It became expected. At this stage, governments began paying attention more seriously. Silver was embedded in energy infrastructure, defense systems, medical equipment, and electronics. Supply disruptions were not just financial risks. They were strategic risks. Stockpiling discussions resurfaced quietly. Meanwhile, mining companies found themselves in an unusual position. Higher prices brought profit, but also pressure. Governments scrutinized exports. Communities demanded concessions. Environmental oversight intensified. The silver supply chain became political. That politicization added another layer of friction. Investors saw it clearly. Even if prices stabilized, supply would remain constrained. Years of underinvestment could not be reversed quickly. The metal had entered a new phase. Silver was repriced, not just revalued, The investigation's outcome, whatever it would be, almost no longer mattered. The damage to perception was permanent. Markets had glimpsed how fragile the system was beneath the surface. That awareness could not be erased. Financial institutions adapted. Some embraced higher silver exposure. Others reduced reliance on complex derivatives tied to metal pricing. Risk departments rewrote models. The old assumptions no longer held. Silver had forced humility. Retail investors, often dismissed, had played a role too. Their insistence on physical ownership exposed the imbalance. One coin at a time, pressure accumulated. It was slow. It was uncoordinated. And it worked in the final phase of the reckoning. One truth stood above all others. Price was no longer the most important factor. Availability was. If you could buy silver, you paid what it cost. If you could not, price was irrelevant. That shift marked the end of an era. Silver did not overthrow the system. It revealed how dependent modern finance was on confidence. How easily complexity masked scarcity. How quickly trust evaporated. When reality intruded, as the markets adjusted, a new equilibrium began forming, one that valued transparency more, one that respected physical limits, one that accepted volatility as the cost of honesty. Silver had done what it always does in times of stress. It told the truth, and the truth was uncomfortable. By the end of the reckoning, silver was no longer underestimated. It was no longer ignored. It had reclaimed its role, not as a relic of the past, but as a barometer of trust. The investigation would conclude. Headlines would fade. Markets would move on, but silver would remain changed, and so would everyone watching it.